you're going to retire, right? Let's hope we all get there. And when you do, you're going to have to make a decision on how much money you earn while you're living and how much you leave behind for your spouse when you die. As a FERS employee, you have three options, one, two, three, and only three, no more, no less. And the three options are as follows. Number one, you can choose to leave a 50% survivor's annuity for your spouse, and you'll take a reduction of 10% off of your annuity. Okay, so I'll use real easy numbers just to give you that point. Say your pension is $1,000. Hopefully it's more than that, but let's make the math easy. $1,000 a month. If you choose this option, you'll get $900 a month. But at your passing, your spouse would get $500 a month, half of the $1,000, for the rest of their life. So option number two is half of that. You can leave your spouse 25% of your annuity at your death at a cost of 5%. So you would take that reduction for the rest of your life, right? As long as you are drawing a pension and your spouse is still living, you would take that reduction in your pension. If your spouse predeceases you, you would get that 10 or 5% back going forward. You would get a pay raise for your pension, if you will, to make up that money that you no longer need to pay for a benefit that will no longer be received. Option number three is to leave no survivor benefit. And what does that cost? Oh, yes, nothing. That's a zero cost pack. So those are your three options as a FERS employee. What we're talking about here is this idea that you are going to draw a pension, and when you die, someone else will get a benefit, right? And we call dying and leaving someone a benefit, we actually call that life insurance. So I'm going to take a moment to help you be a wise consumer of this survivor benefit by just comparing it to one of your other options of life insurance. We could do assets and other planning pieces, but for today's discussion, we're just going to line up two columns to simplify the experience for you here. So on the right-hand column, the blue column, survivor benefit. This is what you would get from the government. On the left-hand side, it's life insurance. If you opted to buy a life insurance policy, what would be the pros and cons of that relative to each other? So let's go down this list. On the left-hand side of the page, you've got the list of concerns. There's many more issues that need to be brought into light, but I'm going to go through these and I'll name a few others when I get done. But payment options, life insurance policy, when you die, you can your heir can either take a lump sum or they can take an annuity. If you pass away with a survivor benefit, it is an annuity. There's nothing lump sum to be paid out if you make that election at retirement. So flexibility and control with a life insurance policy is something that you own, so you can control the death benefit, the cash value if you buy a permanent type policy, or the term of the policy. You can also, you can make any changes you want, and the cash, the lump sum payout, can be controlled by the heir to be spent more in the earlier days or less in the earlier days, more in the latter days. You have all that flexibility inside of that insurance policy. Survivor benefit, you die, someone else gets a check every month until they die, and then it's gone. So the flexibility and the control issue doesn't exist there. You can change your beneficiaries on your life insurance at will. If you own the policy, the owner has the rights to make someone, whoever they want, to be the beneficiary. Whereas with a survivor benefit, it will be your spouse. If you do elect to make someone else your survivor, to receive your survivor benefit besides your spouse, there could be a higher cost to it. Say, we've had some people ask, well, what if I want to leave it to my child? Well, instead of a 10% cost, it can be up to a 40% cost of your pension. And most of the time people go, well, I love my child, but not that much. I don't know that I'm going to give up all 40% to leave them something. So changing beneficiaries and survivor benefits is just something that doesn't necessarily happen. The next one, the next one is what I was just explaining, the insurable interest. Your life insurance policy could be left to your child, right? And that wouldn't change the cost. The life insurance policy is built on your health and the cost at your age, and that's it. Whereas the survivor benefit, if you leave it to someone younger, then they're on the hook for a guaranteed check for a longer period of time, and the cost can be up to that 40%. Your cost for that life insurance policy is based on your age and your health. I've often heard it said you don't buy a life insurance policy with your money, you buy it with your health. So you want to understand that that differential. If you're younger and healthier, and that's a relative term, I know, then a life insurance policy could be lower than 10% cost of your annuity. And I'll show you an illustration of that in just a moment. Whereas the survivor benefit has a standard cost. So if you're older or not as healthy, then that could be a good financial move to take the survivor benefit. Life insurance comes with a tax-free benefit. You buy life insurance with after-tax dollars. The whole death benefit is tax-free. So you buy it with pennies and you end up with dollars at death. That's what insurance does for you. Survivor benefit does have taxable components. All that depends, right, on your surviving spouse's income and all sorts of other elements, but it can be taxable. Inflation, this is a good one. The life insurance policies, if you buy a policy, it depends if it's inflation protected or not. And you would have to carefully ask that question of what is this going to be worth 5, 10, 15 years from now relative to today, and will it cover my needs? Whereas a survivor benefit does come with that same inflation, the cost of living adjustment that you get as a federal retiree. Your spouse would get that too. And I've got much more to share on that before we end today as well. And then the most important, I think, to be careful of here is the FEHB, the health insurance continuation. If you determine that you do not want any survivor benefit from the government, and let's say you bought all life insurance, the life insurance does not give you the rights for your spouse to keep FEHB at your death. So if you want your spouse to have FEHB, the health insurance, after you've passed, they have to be on the annuitant rolls. On the annuitant rolls, follow this, which means that they either have to get the 25 or the 50% survivor benefit. So don't walk away from all of the survivor benefit if your spouse will need the health insurance from the government. The things we didn't cover here are, if you have enough assets, maybe you're self-insured. Sometimes folks will say, I want to make sure I leave some money to my children. Maybe you have a special needs child or some reason that you want to make sure a lump sum is left to your heirs. Again, survivor benefit won't allow you to do that, right? But a life insurance policy could take care of your spouse and possibly your children as well. And then the other issue that you have to continuously address, and then this broadens the scope beyond what we're trying to do today, but I want to at least give you the idea so you don't pigeonhole your decision. We're only talking about replacing 50% of your pension. If you pass away, you left 50% of your pension either in life insurance or survivor benefit, would that be enough to care for your spouse? Or would they need 60, 70, 80% of your pension to live effectively? And then do you have enough money in your TSP to do that? Or do you need to have more insurance in place? How is that actually going to play out in the life of the survivor? That's the broad question. I'm just giving you in a vacuum, two comparatives on these very narrow points. Make sure you broaden this into your financial plan and you consider all those elements, not just the ones on the screen. But this is step one in you not blindly accepting what the government is giving you, and instead you are becoming a wise consumer of your choices, because again, you're going to spend thousands and thousands of dollars on a when you die someone gets a benefit here at retirement, over your retirement. What's the best use of those thousands and thousands of dollars, and what gets the most value for your purpose and your plan in life?